Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we're back in the saddle. I'm back from all of my travels, I guess is the way to put it, or it all becomes a whirlwind just in terms of where we've been. But now starting to get back to normal, so we'll be able to do the EIA show today, macroeconomy, geopolitical show tomorrow, and then the FSC show on Friday. So we're going to break it into our normal three topics. We want to look at what is happening on a global basis, but also how's weather impacting with Hurricane Ian coming on shore. And then where are some of the shifts that are happening, just holistically speaking. And then in this next segment, we're going to go a bit deeper into how is demand doing. And we want to look at both of them now that we're pretty firmly within shoulder season. How is crude demand going? How is product demand? And how do we see that coming on the back end as we get into the winter months? And in the last segment, we're going to look at how have Russian flows changed, have they continued to adjust, and where are some of the flows in the physical market going? We've seen some differentials find some sort of stabilization, but again, there's still some more to come as we go into really end of October into November. So with that being said, the Hurricane Ian is now coming on shore. That it's mostly going to hit more on the demand side than the supply side. We did get some Gulf of Mexico platforms to shut down and evacuate just purely out of caution. So that will reduce some supply. But again, that's something that as the hurricane passes, people come back to the platform, make sure everything is working, everything's operational, everything's safe. And that's usually is a fairly quick turnaround, especially if there was no damage. Now, when you look at where it's hitting, it's coming on shore as a Category 4. It should diminish fairly quickly once it is on shore, but it will dump a significant amount of water. And as you can see here, it is projected to go straight up through not only Georgia, but South Carolina, North Carolina, and then terminating into Virginia until it then continues to disperse. That's just going to make a lot of water, a lot of rain, a lot of people that'll just kind of buckle down, not do much. We did get a bit of a spike in gasoline demand ahead of it, which is typically normal. People try to hoard, do as much as they can. And we do have to talk about Puerto Rico, which was also hit by a hurricane. They are asking for the Jones Act to be waived just to address the big shortfall in diesel that is currently happening right now. So again, there's a lot of weather. This is typically as we get towards the end of the season. Luckily, so far, and obviously not luckily for the Floridians, but this is really the first and only storm this year that has made landfall. So hopefully, outside of obviously Puerto Rico, hopefully that remains the case as we head into the end of the hurricane season. Now, when we look at some globally what is happening, so total oil and product stocks, you can see that we are back to the 3-year average. We're above 2021, and we are now firmly within the normal range. The deficit narrowed from 35.5 to 12.8. So again, we're quickly going up on both the oil and product basis. When you look at total products, this is again total looking at land and floating. We are now in a surplus. We've gone for the surplus widened from 16.8 to 25.3, and there is a lot that continues to be on the floating side that will be transitioned onto land. Again, you can see here we're now above 2021. We are above the average, and we're now pushing towards the top end of that when you, again, factor in both land as well as floating. Total oil product stockpiles, we are now back above 2021. The deficit narrowed from 52.4 to 38. And a lot of this is going to continue as China puts more product onto the water. So just to give you an idea of, and we talked about it in one of our insights, but 15 million tons of fuel export quota is expected to be released and has been released. It equates to about 1 million barrels a day. So the view is that you're going to get a fairly sizable run up in refining capacity with, I should say, utilization rate in China. with the state-owned facilities getting to about 90%, they're currently anywhere between 75 and 80%, and that would pull additional capacity and, again, that crude out of storage. And remember, what we were saying over the last couple of weeks was that China was going to have to increase their export quota because they still have struggling demand onshore due to the uncertainties around COVID, around lockdowns. So in order to really ramp the runs, you were going to have to push additional product into the market. And let's be fair, on the diesel side, there's a lot of money to be made selling diesel into the international market, but it's also shifting some of those moves, because when you look at the movement from 75% to 90%, again, a lot of this product is going to find its way into the Atlantic Basin, where we still have a massive shortfall on the distillate side, on the diesel side, and things continue to be fairly tight, which is, again, going to be a strong price action. But this is also resulting in more product getting stuck in Fujairah, as there's that back and forth between East and West Suez. Now, when we look at land storage, when you look at land storage here, you can see that we're back above 2021. We are in the in the cloud, but again, moving slower. Deficit narrowed from 38 to 29.5. West of Suez, deficit narrowed from 14.5 to 7.7. So again, really getting much closer to the 3-year average. And then east of Suez went from 24.2 to 21.9, but that is going to continue to quickly rally. This is only looking at Japan. When you factor in China, there is still we're well above normal and much closer to the top of the cloud, just based on the amount of Chinese oil storage. Floating storage, here you can see that the surplus widened from 35.3 to 54.2. Floating storage in west of Suez, the deficit widened from 0.3 to negative 1.6. And then when you look at east of Suez, the surplus widened from 35.5 to 51. So again, there was we talked about it, I want to say it was about 4 to 5 weeks ago, where we had a big surge in tankers that were targeting China. That has since dropped off, but this is them showing up. So now as we were saying before, you had that transition from crude in storage, crude in transit, and now you're back to crude in floating storage as you go full circle. And that floating storage, again, is going to become onshore. It's just a matter of timing. Do you have space on not only just the waterways? Do you have space at the docks? And then do you have space in the tanks? Like, is there a need for it right now? And how much is storage costing you offshore versus onshore? So as this transition, this will move from floating storage to onshore storage, and again, continue to move this up. Now, it's normal to see builds this time of year. It's just a matter of what is the pace of the build that matters most, because we are in shoulder season. We should be building. Then you don't look at this and go, oh, well, we're building, so this, therefore, it's bearish. And it's like, well, what is the pace of builds? What is the pace of product movement? And that's really going to dictate kind of where some of those things sit. On the production side, you can see that there was a movement lower of 100,000 barrels. Again, this was due to the Gulf of Mexico, the slowdown in activity, just based on where things were and the hurricane coming through. Crude oil had a drop of 210,000 barrels. Pad 2 had a build of 1.31. Cushing had a build of 690,000. Pad 3 was the one that had the sizable drop of 2.88 million. Pad 1 small. And then you had a build in both pads 4 and 5. And then when you factor in the SPR, there was a draw of 4.79 million, which has been extended. So again, we will get some of this moving further into November on the SPR release and that balancing that we've seen. Now, when you look at Pad 2 was the Toledo caught fire. Unfortunately, there were injuries, there was loss of life, and they just based on the extent of the how much damage has been done, they're saying that it won't really come back to full operation until 2023. So you're going to have a bit of a shift in terms of where is crude storage, where is product moving, and that's going to make a little bit of this spread move out, especially in Pad 2, just given the disruptions that we've now had. So Cushing is going to, you can see when you look at the 5-year average, Cushing is still 16.9 million below the 5-year. But as we were saying, we expect to see that kind of that steady grind up, not fast. It's not going to be in a straight line. It's just going to be that movement, but the trend will be higher. Pad 2 still remaining fairly low as 17.5 million below the 5-year, but then Pad 3 is 11 million above the 5-year. So again, Pad 2 and Cushing are the ones that are resulting in that drop in that 5-year average. So when you look at Pad 3, you can see that this is the third highest it's been. The only times it was higher was 2016 and obviously 2020. It's right in line with 2017 at the moment. You can see it's just slightly above, but as you look at it, we're very normal for Pad 3. But now the tax man starts to come around as we get into year end, and typically in Pad 3 they will look to get that crude lower, which is why you normally see those drops into year end, because they count barrels. So you want to limit the amount of barrels you have in Pad 3 so you're not paying taxes on it. So again, these are things that will be very important to look at as we continue to look at where are flows, where's activity, how are things shifting, where are exports going, because exports still remain strong. We don't see that changing in the near term. So now when we look at Cushing here, you can see just that slow move higher. There's typically builds as we get into year end. The pace is still fairly slow, so we don't see this big surge. But when you look at other years, this is where you normally start to get that grind higher. And again, nothing that we're seeing is very surprising at this point in time. So when you look at runs were down 3%, going from 93.6% to 90.6%. You had drops in Pad 2, Pad 3. It's very normal for this time of year. Obviously, you had the issues at Toledo, but we're firmly in shoulder season. This really kicks it off. It will continue through October. So this is when you normally take things down, increase turnarounds, do maintenance, both. All your planned maintenance to make sure that you're firing back up when we have the most demand, which is as we go into the winter months. And obviously for diesel, it's still elevated in comparison to the 5-year average, but that will normalize fairly quickly. We don't see anything really crazy in terms of utilization rates at this point in time versus the previous few years. When you look at run rates here, you can see again just moving that down the normal path. You can see it's fairly steep. So again, to see another drop of 2-3%, another drop of 2-3%, and really bottoming out in, let's call it the middle to end of October, is very normal. So nothing to say one way or the other when we're looking at the refinery throughput. Imports down 498,000 barrels, only 199,000 below the 5-year. Pad 2, even though it had a drop of 110,000, it's still 496,000 barrels a day above average. Now, as you have those hiccups in terms of refining activity, this is going to result in more crude going into storage because you still have a decent amount of imports coming down. But as that demand diminishes, just with run rates moving lower, that is going to result in, again, more coming through and being stored. Imports into Pad 3 were up 137,000 barrels, still 727,000 below the 5-year. And this is going to be the balance where they're going to want to increase the amount and availability of medium sweets, heavy sours to ensure that they have enough capacity to really target that distillate cut. Pad 5 remaining lumpy, drop of 367,000 barrels a day, but still right in line with the 5-year average. So again, we do expect to see Pad 2 not really bouncing back up, just being well above the 5-year, still continuing to see some of that demand as Pad 3 continues to really remain fairly weak. As you can see here in terms of the import data, we expect it to be at the low end of the cloud at this point, below the 5-year, but grind a bit higher. It's just there's a lot of crude sitting in Pad 3. The question is going to be what type of crude is there. So they're going to continue to export as much light sweet as possible, import as much medium sweet, heavy sour as they can to feed it into the more complex refiners that exist in the region. Pad 2 here, you can see still remaining elevated. We expect it to come down into the top end of the cloud. So there will be some pressure to the downside, but again, it's still going to be elevated. There's still a lot of demand. There's still margin to be made bringing this Canadian crude down, running it through the refiners. It's just there's going to be less capacity because Toledo will be offline for pretty much until we get into 2023. Now, when you look at implied demand finally had a bounce. We've been saying that gasoline demand was about 8.7, 8.8. Here you can see that there was a bounce of 503,000 barrels on the gasoline front, going from 8.3 to 8.8, still below the 5-year average, but again, much closer to what we know it to be. And a lot of this was being driven based on that run up ahead of the hurricane. So you will see that drop down just because there's that push to get as much gasoline into the gas stations, make sure that people have the ability to escape, to evacuate. Distillate, a big increase of 769,000 barrels. We were too low. Now this is too high. We're somewhere between that 3.7, 3.8 million barrels a day. It could be on the lower end just until we get to winter burn, winter heating, and then that'll move back up. But again, we had to see some of those movements. Same with jet fuel, too low. And now it's up to, it bounced 660,000 barrels. When we still have it at that 1.45, 1.55, but that was the big surge, moving things through. You also had that jet fuel moving into the market, making sure that there were people that could get out of the path. And then you also had Rosh Hashanah. You had people that were traveling for the extended, the long weekend. So that's kind of normal when you look at it from a gasoline side. You had hurricanes. You had and obviously it depends on location in terms of where is the Jewish population and how much. And typically they're on the coastal sides, so you normally have a decent amount of driving that picks up. And what is it? A 2-day a long weekend with some of that additional driving. Propane, increase of 66,000 barrels. Again, still 250,000 off the 5-year. When you look at local demand, we continue to see a diminished demand for petrochemicals. So very normal to continue to see that move lower, just given where petrochemicals are, but with imports still remain very robust. Now, when you look at gasoline implied demand, we're still below that 10-year average when you're looking at just what is the average in general. But it's going to stay at that average pace. We will move back up, and I think we're going to hold in about that 8.6, 8.8, depending on time. What is the weather doing? People like to travel a bit more in the fall just for fall foliage. All the fun fall activities that typically happen. So, but again, it's still diminishing. And that you still have the pressure on the economic side, which is why we're not going to get back or be over 9 million barrels a day of demand. It's just we don't have that capacity in the market. And even as people start to kind of normalize their work schedules, people aren't going in 5 days a week. You are seeing people work from home 2-3 days a week, and as we said at the very beginning of COVID, that as that becomes the new normal, you're going to lose some of that weekday travel. You will get an increase on weekend travel, but again, that's going to be some of the back and forth. And then as the hurricane, so typically you have a bump in demand ahead of a hurricane and then a big drop down during the hurricane, just because people are locked in. They're at the locations that they're going to be in, and they're going to let things pass until they start to get back to normal. So again, still something very in line with the situation. Crude oil inventories excluding SPR. It's at an elevated level at this point for 2022. You can see that we're at the highest point of 2022, and we see it just grinding higher. It's not a huge move up. Things are fairly stable. It's well above where we were in 2021, and we do see some of those additional builds coming through as we get towards the end of October and into November. Days of supply fairly normal. We expect it to track pretty close to 2021. Nothing to show one way or the other. Refinery run rates came down So that will put more days of supply in the tanks, and then that's just what it is in terms of when you're looking at oil and storage. Crude, refinery runs. As refinery runs come down, you'll obviously have more days of supply. Now, when we look at product and crude, here you can see that we're pretty much tracking right in line with where we were in about 2012 or so. So still on the low end. It's just below where we were in 2021. And all of this still remains driven by distillate. Distillate continues to be in the most bullish for pricing, bearish for storage side in terms of just the amount of product. We're still on the pad 1, 29 year all-time lows, still on the low end across the board. And again, that is the biggest driver for what we see, and which is why diesel is going to continue to see some of those sticky prices. Gasoline had a small draw when you look at just where the products were coming through. And again, this is normal. You had the move through. There was a draw in gasoline of 2.42 million, with a lot of that being driven by Pad 1. Pad 2 is going to continue to be on the low end. There was a small draw there, but remember, Pad 1, Florida's in Pad 1, the Carolinas are in Pad 1, so it's normal to see that drawdown as this gets pushed into the market, and then as things slow, we'll see this pick back up, and we'll see builds come back into the gasoline market. Now, when you look at distillate had a draw of 2.89 million, draws pretty much across the board. And when you look at it from just holistically, Pad 1 had a drop of 20.2 million below the 5-year average. But then this is the now the second lowest we've ever been or at least going back to 1993. So again, distillate is going to continue to be a big driving force. Jet fuel had a big drop as well. A lot of that was pushed into the market. And then remember, kerosene, diesel are not that far apart. So you can see one going to the other depending on where pricing is and where demand is. Now, when you look at the futures curve, you can see that it has shifted all the way down into pretty much across the board. You're seeing a lot of that pressure as things move down. And this is in regards to a global recession, the view that you're going to get a big hit to demand, and that is really helping to push things down. So even though obviously the front month will remain volatile, you're seeing more and more pressure come into the belly of the curve. And the outer years, again, it's hard to say when that'll reverse. Obviously, we think that the back end of the curve is fairly cheap, would be a good investment on the longer term basis. But again, does that mean it can't go down another $5? No. It's just when there's panic, and there's nothing you can do about it. But that's where we do see, as you go further down the curve, a lot of opportunity to get involved. And then floating storage dropped back to 2021 levels. And again, this just means that we will get more storage this week in terms of where storage is, especially in Pad 3, because it's that timing delay of when is it floating storage, when does it come on land. So this will pivot to coming and showing up in the data in general. And we just expect it to remain fairly stable and just lumpy at the bottom of the normal range. So that's what we have for you for this segment. In the next segment, we're going to go deeper into refined products. What is happening now? What do we expect to happen as we progress through not only shoulder season, but then getting into the winter months?